The Greek saga has reached a new crisis pitch, with the prospect of leaving the Eurozone becoming an ever more real possibility. But with the majority of bailout money going towards banks, what has really changed in the financial sector since the last crisis? Stanford professor and author Anat R Admati joins me with her thoughts. Now, why didn't the Troika force its bailout money to be spent on strengthening government coffers, as was done with other Eurozone member nations?
About 90% of money was basically paid to the creditor, which bailed out creditors, of course, prevented them from losing and helped Greece not default, but otherwise it didn't. It just bought kind of time.
Now, do you think that this situation strengthens the argument that, the market knows best, giving the public and politicians less control over the type of capital that banks are holding?
It really is a question of who should be making risky loans. We don't have governments make investments in stock markets, right? But here we have risky lending. And risky lending, like subprime lending, like lending to the Greek government, which might not be able to pay its debt, is something that requires some expertise, which you'd like somebody to use and adjust the rates and decide who's creditworthy. And importantly, if somebody makes a risky investment and it might not work out, they should be able to absorb their losses, swallow that haircut, and not take down the road with them. And so the question is, what happens when banks get literally incentives and almost encouragement from regulators to make loans that are really risky without really both checking much of the creditworthiness of the borrower, in this case Greece, and without being able to absorb their losses. So then the governments come and bail them out.
Obviously, you've been campaigning since the last financial crisis for governments to really take back this control. So how frustrated are you, given the current state of affairs and the fact that, frankly, nothing has been learned, and Greece is a polarizing example of that?
I'm very frustrated because this crisis of 2007, 2009 was really quite massive. We're still feeling it. Greece thing is just kind of a follow on that. But it so starkly illustrates the mistakes, the errors that were made before the previous crisis, which actually were not corrected. It was zero risk weight to AAA mortgage-backed securities that turned out to be quite risky. And it was zero risk weight, meaning that banks could take deposit money into Greek debt, government debt, and have no ability to absorb losses if that debt, which is judged as junk and paying like that, at least in 2008-9, doesn't actually pay. And so all lending and all credit is distorted. You get too much and you get too little at the same time. The economies are suffering, and the regulators are not doing the most obvious things to do in this case.
Right. Now, in the short term, though, when we go back to the Greek example, there's still uncertainty on how further destabilizing the situation will be if the ECB doesn't step in and offer more liquidity support. So if that is the case, do you think that the contagion is just going to continue to spread further?
Well, contagion it comes in many different ways. There's always a little bit of a direct contagion in the sense that, some banks elsewhere lend to Greek companies. There'll be defaults that go through the system. But mostly in this case, it's what's called this sort of information contagion, which is the notion that the euro is not irreversible and that what could happen here might be a sign. And in that sense, all of Eurozone, definitely, maybe Europe as a whole, will suffer because the market is now going to assess that some supposedly impossible things are possible.
So do you think that there should even be a question about whether Greece stays or not?
Well, the question is for whom? I mean, people are thinking very short term. The emotions are high right now. Obviously, the negotiations have been going poorly. I don't know if there's going to be a miracle in the next few hours. There was a combination of things, including the ECB's decision to really squeeze the banks, and some of these kinds of runs can become very much self-fulfilling. So you never know what the difference is between a liquidity problem and a solvency problem in this kind of situation. One kind of feeds on the other. And so it would be extremely regrettable if the euro does not hold together. If after being told to burn the printing presses, there's no way for Greece to default without leaving the euro.